Morning, Market Chameleons. Happy Monday and post Super Bowl day. It was a great Super Bowl last night. You watch it, D?
Good morning. Yeah, I did. Yeah, that was a fun game to watch.
I think there's a mattress salesman in Tampa. I want to say his name's Matt, the mattress salesman. Maybe Mike Moreau will mention him on the chat. But he bet $3.5 million middle of last week on the Buccaneers.
Oh, so
he was.
that was a huge win.
Yeah, super happy. All right,
what were the odds? Were they almost even?
I think it was 3 points were the odds
in favor of KC.
Yeah. So I think he got an extra 3 points.
Oh.
The game wasn't even close, which was very. Well, let's get started with the disclaimer.
Okay. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. Here's the disclaimer, everyone.
Excellent. So what are you seeing this morning?
Let me take a look. We'll take a look at the pre-market movers. And then we'll take a look at the earnings, what's coming up in the earnings front, see if we could get some insights and how the options are lining up as far as predicting what the magnitude of the move is compared to historical moves. Just mentioned today, we're not going to have the webinar, because I have to go, unfortunately, to a funeral today. So we're going to skip this Monday. But we'll do the pre-market. We'll do the pre-market show, and hopefully next Monday, everything's good, and we'll do the webinar next Monday.
Excellent.
Let's take a look. These are stocks that are moving in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Let's first filter out the higher market cap stocks, see what's going on in stocks that are $20 billion market cap or higher. So I'm using this filter over here, market cap. The first one pops up here, up 9.1%. That's, how do you say that?
Palantir.
Palantir. So it looks like they have a contract with IBM. These are both software companies. They would like do data analytics.
Palantir, yeah.
Yeah. So, and this stock's relatively new as far as IPO, right?
I think you maybe have one earnings, two earnings. Yeah, one earnings.
Yeah. So you could see here, closed 34.05. It was up 6% Friday. As this morning, it's trading 37.30 in the pre-market hours, up 9.5%. And you could come down here, read some of the news, but here it is, something, a partnership with IBM. You could take a look at it and, figure out if that's justified in a price move. Coming down here, I'm seeing some market move, but not this one. Palantir is trading 3.1 million shares in the pre-market. Some of these other ones, 17,000, 44,000, not a lot of volume. GM up 2.8%. I think they had a commercial yesterday, didn't they, on the
Super Bowl? Yeah.
I thought so, with electrical vehicles.
Yep.
So they're up 2.8% in the pre-market. Tesla, they had some news with Bitcoin. I think that they invested in Bitcoin. I saw that come across the
$1.5 billion, they say.
$1.5 billion in Bitcoins.
Yep. And they're going to start taking it as a method of buying your Tesla.
Okay. So up 2.3%. I'm not sure if that's the news that's driving it, but that was interesting. Nothing else is jumping out at me. We see that 47 stocks made the percentage gainers list using this criteria, 8 on the percentage decliners list. From that perspective, looks like a more bullish opening, favors the more bullish, favorable to the bullish side. There are no questions on the pre-market. I'm going to jump to earnings. Well,
great.
Okay. So let's take a look what's coming up in the earnings front. And these, we're going to take a look at stocks that are expected to report earnings in the next 2 weeks. You know what, before I do that, let's gain some insights. What I usually don't go down here for these insights. So let me take a look at what's going on here. So this is tracking in the last 2 weeks stocks that reported earnings, and in aggregate, what happened to those stocks. How many of them were up after earnings? How many were down? What happened to the option straddle? So let me I'm going to just use this filter for S&P 500 stocks. Okay, so these are S&P 500 stocks. Let's also use this filter. So these are stocks that trade at least 5,000 option contracts or more per day on average. So using these filters, let's come down here to the insights. So here's what this is saying, that in the previous 2 weeks, 33 stocks that reported we have 33 that and 40 that met these criteria. So in total, 73 meeting this criteria in the SPY holdings, trade over 5,000 option contracts or more. So 45% of them, after reporting earnings, they gapped up at the opening on average 4.7%. Okay, so that's the average gap move, and 45% of them, had positive reaction that day. On average that day, by the end of the day, the average return was 4.1%. 54.8% of those stocks were lower on the day. The average gap was down 1.4%. On average, they closed down 3.1%. So what does this mean? That although there are slightly more stocks that closed lower after reporting earnings than higher, the ones that were up on a day, the magnitude of the gap move to the upside was much higher than the magnitude of the move at the opening to the downside. So you could see here that when it was rewarded big time, right? 4.7% average gap move versus down 1.4%. So if you're just playing the straddle, to me, just eyeballing it, you're better off just buying the calls, because the puts weren't, you could see here, the down moves were kind of muted on average. By the end of the day, it looks like after the opening, on average, even though they gapped up 4.7%, they only finished down up 4.1%. So it looks like on average, they drifted a little bit lower from the opening price. But here's the other thing. The ones that gapped down 1.4%, on average finished down 3.1%. So in both situations, from the opening price, the drift to the closing price on average was lower. So you see what I mean, Will? Does that make sense? Gap down 1.4%, finish low. Will, you're on mute. That on average down 3.1%. So
sorry about that. I was in the midst of a sneeze. It seems really interesting. Actually, it makes me wonder about, the skew, because it's always the puts that are, typically jacked up. And it looks like the moves to the upside have been pretty interesting.
Yeah. So it's like if you're playing to the upside, definitely, even though, 54% of them were lower at the morning, but look at the, if you did the averages, I think, multiply this times this times this, you're probably positive here that overall you're better off, in my opinion, if you were just playing the call, if you're just going long, instead of call and put, because you could see there the puts tended to be more muted. And really, if you're playing, you're better off waiting for that down move, and then buying the puts almost after the opening, right? Because it just most of them downside move was done after the opening price, right? Not in the gap, but after the opening price, which would have allowed you probably to buy those puts cheaper anyway.
Yeah, they'll crush them in the morning, right? Typically,
they'll crush them in the morning. So so holding those puts were probably a better deal, doing it waiting for actually confirmation from a negative earnings release, and then buying them at the during the day than the day before. Now, let's take a look at what the straddle did. So if you're just buying call and put, right? Just buying the call and the put. So 37% of them, the straddle ended up being profitable the next day. 63% of them were lost money, right? So if you bought the straddle day before, held it to the day before earnings, held it to the next day after reporting earnings to the end of the day from, so you held it for one whole day around earnings. 37% of those were profitable for an average gain of 32.8%. 63% of them, they were overvalued, so they got crushed for an average loss of 40.5%. So just looking at it this way, the straddles on net were losers. All right, if you're just doing it, you could see that the magnitude here, they got crushed more often than were profitable, and on average, they lost more than they gained. All right, let me know if you have questions, but I'll just keep going through, through these. So what about if we split up those straddles, right? And we just did the straddles that, if we split up the straddles that looked undervalued prior to earnings, and then we split them up to straddles that looked overvalued into earnings, okay? So here, where the implied move was greater than the historical average, what happened? So in other words, the straddle being priced ahead of earnings, let's say is 10%, but on average, the stock historically after earnings only moved 8%. In other words, the implied move was above what historically on average it moves. So what happened there? So here we see that a little bit slightly better than that 33.9% of those straddles from the long side were profitable for an average gain of 29%. 66 were unprofitable, meaning that they did end up being overpriced for an average loss of 39%. So you could see there that the ones that were above the historical average, right, tended to be a little bit more often overpriced versus the entire group. Does that make sense? Hopefully.
There's no comments either way, so I'm assuming it makes sense.
Okay.
There is a little delay, remember. Okay.
Then we're looking at straddles. What about the straddles that tended to look a little bit undervalued? In other words, that the premium in the straddles, the implied move was below the historical average moves. So that's 50-50. Half of them ended up, being profitable, half of them not, for an average of 43%. The ones that were profitable, the ones unprofitable, average 48.5%. So overall, it just looks like, if you're doing straddles across the board, they tended to be, which is, I think, typical, tended to overestimate the move. Obviously, the ones that were already above the historical averages overestimated it by a little bit more often. So hopefully that makes sense. But again, that's kind of getting insights in the last 2 weeks, what's been happening.
Which are two of the bigger earnings weeks. So
right. Let's go to what's coming up.
Just a question from this report. I know you used the screener and screened it down a little bit, but can we see how many of the S&P 500 companies have actually reported?
Like, oh, you mean like just without this filter?
I guess if you don't put the average option filter, just the S&P 500, that will show us how many have reported today.
In the last 2 weeks, remember, it's just looking in the last 2 weeks. So over here, you see that's the total number over here.
Gotcha.
So, then these are like with the options. These are just looking at all. These are looking with options. And Right, probably, if you do the last month, it'll be more, but this is just looking at the most recent history, just to kind of give us guidance what's been going on recently. Let me take off the filter S&P 500. Let's go to, on average, trading 5,000 contracts or more per day. So let's take a look what's coming up in the next 2 weeks. So here we have today after the market closed, TTWO. That's expected to report today after the market closed. The straddle as of Friday's close was implying a move of 6.8% in either direction. Again, when you're buying a straddle, buying a call, buying a put, we're looking at the magnitude of the move up or down, 6.8%. That compares to a historical average move, 4-quarter average move of 6.9%, and a historical 12-quarter actual average move of 6.6%. So that's kind of in line with the historical averages, and we see the high move is 13.8% in the last 12 quarters in that stock. CHGG, that's also expected to report today after the market close. Straddle as of Friday's close, we're not open yet, Friday's close. The straddle's implying a move of 12.9%. That compares to a 4-quarter average move of 13.1% and a 12-quarter average move of 11.5%. So kind of in line with that 4-quarter average, a little bit above the 1.4% above the 12-quarter average. The high move on that stock, 32.3% in the last 12 quarters. SPG, that's a REIT, I believe.
Yes, Simon Property Group, I think.
So that's expected to report today after the market close. The straddle, excuse me, straddle's implying move of 7.6%. That compares to 4-quarter average move of 1.8% and 12-quarter average move of 1.9%. High move on that, 4% in the last 12 quarters. So you could see here about 5.5% above the historical averages. These are tomorrow before the market opens. We could go over the. Do you have any questions, Will, on anything?
No questions have popped up on the earnings yet, D.
Okay. So these are tomorrow before the market opens. NRZ expected move of 8.2%, compares to a 4-quarter average move of 5.3% and 12-quarter average move 2.9%. So we see 2.9% above the 4-quarter average, 5.3% above the 12-quarter average. High move on that stock, 9.3% in the last 12 quarters. COTY, that is also tomorrow before the market opens. The implied move is 17.4%. That compares to a 13.2% 4-quarter average move and a 13.3% 12-quarter average move. The high move on that, 32.2% in the last 12 quarters. If you want, we could take a look at it, take a deeper dive into one of these. Should we do maybe like this one?
Sure.
Take 2. Yeah. So this is, wow, I didn't realize it was $200 stock, but let's just take a look at this one. TTWO.
Seems like everything's a $200 stock now.
Yeah, everything's $200 target. All right, so we're looking at Take-Two Interactive, and what is this in the gaming industry?
I think it's in the gaming space. Yep.
Electronic gaming. So we've seen a lot of enthusiasm in that space right now. Let's take a look at what historically the stock did relative to where the options were pricing the implied move. So here you see these bars. This is the move day before earnings, what the straddle was anticipating, and the green bar is the actual move to the upside. The red bar was the actual move to the downside. So you could compare the expected move versus the actual. So let's take a look at this one. November 5th, the company reported earnings after the market closed. That day, it was up 3.9%. The day before, the straddle was implying a move of 5.7%. So you could see that move was within the expected range. So the move was more muted than the straddle was implying. This red bar here, as an example, February 6th, after the market closed, 2020, the stock reported earnings. That day, the stock was down 11.9%. The straddle was implying a move of 5.6%. So if you sold that straddle the day before, you'd have to buy it back for a higher price the next day. So it would be losing money from the sell side, making money from the buy side. So let's take a look at the averages. The options market tended to overestimate the move 67% of the time. 67% of the time, the expected move overestimated was higher than the actual move. So here, on average, going into earnings, the straddle implied a move of 7.5% in either direction, compared to the average realized move, the stock realized move of 6.6%. So you got about a 0.9% differential between the implied and realized. Okay, here's 7.5 versus 6.6. Let's take a look at what the implied volatility tended to do. So here we're looking at a 30-day constant maturity option. So we're not looking at the very near-term option, but an option that expires 30 days out because it has more vega. The short-term option has more gamma, meaning there's more just the move priced in. As you go out further, it has more vega, so it's more sensitive to implied volatility. Excuse me, here on average, the day after earnings, the implied volatility on that 30-day constant maturity option tended to decline by 24%. So day before earnings, the implied volatility was 46.1. Day after earnings, implied volatility was 34.8. 5 days later, the implied volatility was 33.5, so it continued to decline 5 days later. So 46.1 right here. So it's kind of where we are right now, 44.2, pretty close. And here you have the breakdown of the data. So starting 5 days before, day before, implied volatility, day of, we got the averages, and then what the implied volatility tended to do leading out of earnings. Any questions there? Well,
Robert Black was asking, can Dimitri give some insight on how these straddles work into when you're looking at trades, basically? So what he's asking.
Which one's the straddles?
Yeah.
Okay. So let's take this one is reporting today after the market closed. So I'll take a look at this one. Let's go to the options chain over here. So here's Feb 12th, Feb 5th already expired. So this will go away once the market opens, but here's Feb 12th. So this expiration is going to cover, this is the nearest term expiration that's going to cover earnings. So straddle, the stock closed at 207.50. All right, so I'm going to use this over here as the at the monies right now. So let's say I'm going to approach it from the sell side right now. You could do sell side or buy side. So let's do the sell side. 207.5. If I sell the call, I'm clicking on this bid 690. So here it is, selling Feb 12 call, 207 call for $6.90. Okay, and then for the straddle, I'm selling the put to 690. Okay, so they happen to be the same price, 690 and 690. So you could see here, this is selling the straddle. The first one's selling the call, second one's selling the put, each for 690. So let's run that strategy. So this is what it looks like at expiration. So anywhere in the green, right? Anywhere in that green, you would be profitable, because if the stock, obviously, if the stock just sits there at 207.50, you would have both, let's say exactly 207.50, both options expire worthless. That's where you make, that entire credit, $13.80. If you sold it for 690, assuming you sold it for 690. Now, one thing here to keep in mind is this, as I'm looking at it, is the spread. So you see the spread here. I mean, what is that, 80 cents between the bid and offer? Fair and midpoint is 14.20. when you're going to execute, keep in mind, you want to get your execution as close to the midpoint as possible. The further you go away from the midpoint, the more you're paying a fee to get your trade executed, right? So if the midpoint, which we consider the immediate fair value, is 1420, if you execute at 1380, it's like 60 cents you paid to the market makers to execute that trade. Okay, so this is using 1380 as if you just got executed at the worst price of the quote. So now we know, like, the stock, here's your break even down to this spot. Here's your break even down to this spot. So how does this range compare to historical moves? So let's just take a look. I'm going to plot the last 12 historical moves, the percentage moves. So you could see here, right, how many landed in the green and how many landed out in the red. So quite a bit, right, of these historical moves landed outside the red, and you could see by far, some of these here, it was down 13.8%. Some of these were down 11.9, 11.7, which would have been outside the current range. All right, what if we just did the average? If I just took the average move, so you see the average move is right where the break even is. So right now, the options are kind of pricing in the average moves in line, right where your break evens are. So it's not within the green, it's not really within the red, kind of right in line with where the average moves were. So it's just one way to start comparing. And I'm just looking at the straddle, right? I'm not, you could then add wings to that or move this straddle around, but this is like, if you wanted just to start out visually doing the straddle, this is one way just to compare it. What happened to last earnings? So here's the last earnings. The stock was up 3.9%. So if we do exactly that, then this would be profitable, right? Last 12, obviously not as clear, right? Because you get a lot of those. I would just eyeballing it. To me, it looks like almost half of them were outside the range, half of them were within the range. Yeah. Well, we actually have the stats we just looked at. Is that helpful with the straddle?
Yeah, that was interesting.
Okay. Let me close this really quickly. Well, we have 3 minutes left. If you have any questions, well, I'll take questions. Otherwise, let's just see what Take-Two did since its last reported earnings. So we see here, since it reported earnings last quarter, the stock has continued to climb and drift higher in the last, whatever it is, 3 months. It's up 18.4%. That compares to historically, on average, it moves up 5.8% on average between earnings, and a 1 standard deviation move is 8.7%. So we see here that it is up over 2 standard deviations from what it typically moves. And again, some of that could be due just to the market also going up. So take that into consideration. But it's, at least from a historical perspective, it looks like the market is looking at an optimistic report. And we could see here, historically, when we've had big moves, historical drifts, like over here, it was up 30% between earnings. After reporting earnings, that was down 5.9%. So it may have reported a good earnings, but it might have already been priced in there. So that's what we're looking at, like how much enthusiasm is priced in versus historical. Here we had a move of 21% to the upside, and on this occasion, it gained another 5.9% after reporting earnings. So this way you could kind of go down and just take a look at, what tended to happen after a large drift to the upside or downside, or a muted drift in the reported earnings. How was the magnitude of the move? Well, we're at 9:30, so if there are no questions.
Yep, great job, Dima. The Chameleons send their condolences. Wish you the family all their best. And great job as always, D. You have a great day.
Thanks, everyone. Stay safe. Have a great trading day. Hope to see you guys tomorrow morning. Thanks for joining us.
Excellent. Actually, Alex, just remember, he wants to look at SQ. Do a look at SQ. Earnings, I think, are coming towards the middle of the month.
Okay.
I'll try to remember for tomorrow. So join us tomorrow, Alex. We'll get to that. D, have a great day. I will talk to everyone tomorrow morning. Trade in peace, everybody.